In this presentation, we will discuss year-end documentation we can provide to the client and documentation that we might want to help the client provide to the end of the year accountant, such as for tax preparation. So the year-end documentation will be much the same as the month-end documentation, but we'll run it for the year. So we may want to give the same month-end information we might give in, say, December, and include with it For more accounting information and accounting courses, visit our website at accountinginstruction.info. Balance sheet as of the end of December. Now that will match the balance sheet as of our normal documentation because it's as of a point in time. So we'll just have that same balance sheet as of that point in time. And then we'll have the profit and loss. We can give the profit and loss for December, giving our monthly profit and loss or income statement. And then, of course, we need one for the entire year. That's the one that's going to be used by tax preparation in order to start to generate the taxes. Then we're going to have the trial balance, at least for smaller businesses. We'll use the income statement for that. So for a Schedule C type of business, main report that they need then is going to be the profit and loss and income statement for the entire year. A trial balance is more of a report we might want to get to the tax preparer at the end of the year or provide it to the client at the end of the year to give to the tax preparer. It's not a report that the client would really use much because it's going to have debits and credits involved in it, but it's often a useful starting point from the trial balance in order to make any adjustments needed for the tax preparation or financial statements at the end of the year. So it's useful to have the trial balance when giving it to someone who's going to make any type of adjustments, because that might be a useful form for them to start with. Any accounts receivable detail, if we're looking at accounts receivable, again, mostly cash basis bookkeeping, we're not going to be tracking accounts receivable. However, if we're doing any invoices or any kind of, if we take on any added work such as that, any accounts receivable detail would be useful as well as we go. We also want to discuss the type of documentation we would want to provide to the tax preparer or to the financial statement preparer at the end of the year. And that would include things like the loan documentation. So any loans that happened during the year, if we had new loans, if we financed the equipment, if we took loans from the bank, then we want to give those to the tax preparer and let them know how we recorded the loan and what adjustments they may need to do in order to add any information needed. In other words, if it's a simple Schedule C, then you want to check and make sure that the interest income on the loan is recorded as it needs to be for taxes. So the loan documentation can help to make that adjustment. Credit card documentation. However we have set up the credit card, if we did the credit card outside of the system and just grouped everything into like a credit card expense, then we're going to have to I hope the client or the tax preparer just categorize whatever's in the credit cards to the proper category, reallocate that information to the proper category. If we've been tracking the credit cards for the full service system and being more on an accrual basis, then the credit card should be okay, and we should be good there. It just depends on what type of system we are using as to whether we need to give the credit card statements to, say, the tax preparer. Large purchases, if they purchase large equipment, especially if they financed it, but even if they didn't, we need to give that information to the tax preparer because they're going to need to put it on the books as depreciation. They're going to have to figure out depreciation. We didn't expense it even on a cash basis. We didn't expense it because it's a large purchase. Therefore, they're going to have to figure out depreciation. There's not really any getting around that. We could even if we entered our books on a full service bookkeeping, even if we made adjustments, we probably wouldn't be recording depreciation, or it's better or easier for the tax preparation software to record depreciation on a tax basis, which will be different oftentimes than a book basis. So we didn't record depreciation. It's an adjusting entry typically. That's one we kind of have to leave to the end of the year tax preparation, at least for tax purposes. And therefore, in order to make sure that that happens, any large purchases we need to give to the tax preparation. Payroll documentation. Again, it kind of depends on how we enter the information into the system as to how correct payroll will be. If we're just entering the net check and we're on a cash basis system, then we might want to give the payroll information to the tax preparer, the 940s, the 941s, the W-2s and W-3s at least, because that information is stuff that they can then use to break out any categorization they need to it. For example, they might have to break out the amount of wages payable, the expense, versus wages tax payable, the taxes, the employer taxes for payroll taxes, should be on different lines. So in order to break that out, they can use that. If there's an accrual issue, like a timing difference, because we recorded it on a cash basis, and they need to record that timing difference between the expense that was recognized on an accrual versus cash, then again, they can do that and tie that in with that documentation. So if we're running the payroll, or if a third party's running the payroll, we can easily give a third party will typically have a standard set of information, which will include the 941s, the 940s, which are the month end and the year end, the W-3, which is like a summary of all the W-2 documentation, and typically a summary report, which will give mainly what we need for that information to make any year-end adjustments to make sure we're categorizing payroll, payroll taxes, payroll liabilities correctly. Then we've got the insurance documentation, and this depends on how we're recording insurance. If we record the insurance all as an asset or all as an expense, then we're going to have to depend on the year-end adjustments to make any adjustments that are going to be needed. So, and that means that if we're on a cash basis, for taxes, can they expense the whole thing on a cash basis? Or do we have to recognize only the part that was used during that time period? So the insurance policy will give the term of the insurance, how long the insurance policy was and what was covered within it, so that the year-end adjustment can be made in terms of what you paid, how much of it was consumed during this time period, and expensed the appropriate amount for tax purposes. Backup the QuickBooks file. Now we give the backup file every time, or we could give the backup file every month. We may also want to give the backup file to the tax preparer, and that'll actually limit a lot of the information we give, they need from us, in other words. So, such as the financial statements from us, if they have QuickBooks, we can just give them the backup file, and they can open it up and they can get any documentation they need from it. So they can get the backup file, which will basically be the financial statements, and then they can look at any detail on how we entered anything. We can explain to them how we entered stuff. They would still need this information in addition from the client to support that backup file. Note that if they do use the backup file, it's not connected to our file. So any adjustments they make with the backup file are not going to affect us on our file. And if we want their adjustments, we'll talk a little bit more about this later, but just note that if we want their adjustments, we're going to have to figure out how we're going to do that, so we can determine whether or not we would like to enter the year-end adjustments by an accountant or tax preparer or whatever into our bookkeeping system, and discuss how we would do that. They can give us the adjustments on a paper file and we can enter them into our system manually as we so choose, or we can not enter them and just keep going forward with this system and say, hey, we're just kind of entering the data and getting the profit loss basically correct depending on year-end adjustments for any adjustments needed. Or we can actually get the backup file back and restore it. However, if we do that, we need to be careful that we're not entering data into the interim time period, because we'll lose it at that point. So we'll talk a little bit more about that later. For more accounting information and accounting courses, visit our website at accountinginstruction.info.